Hi, and welcome to the Workshop 2 video. Hopefully you've had a chance to introduce yourself in the bio section by now and also set up Connect to start working on Chapter 1 problems. We're on to Chapter 2 now in Workshop 2, so hopefully you have the study guide in front of you. This is the Workshop 2 study guide. We'll go down a couple different things on the first page and then look at some journal entries and double entry accounting, some concepts that are probably going to be new to most of you. But the different types of accounts, starting on page 1, these basically follow the accounting equation that we learned in Chapter 1. So assets equals liabilities plus equity, that's our accounting equation. I've listed some of the different types of asset accounts there, and as it's noted halfway down the page, these accounts are listed by order of liquidity. So what that word means is the ability to convert it to cash. So cash obviously is already cash, so that is the most liquid asset that we'll have. So that almost always comes first on your balance sheet. And then we get into other assets that take longer to turn into cash. So accounts receivable, inventory, supplies, those, for example, take some time to collect our receivables, to sell our inventory, for example. So they'll become cash later, but at this time they're in a different form, and so we list them later down on the balance sheet. Also in that section, equipment, building, and land. These are what we call property, plant, and equipment, non-current assets. If an asset is converted to cash within a year, then we'll put it in the current section. If it's not, then we'll put it in the long-term section. So equipment, think about this. This is something that we use to operate our machines or the land that our building's set on. These are things that we're going to keep for a long period of time. So they don't go in the current section, they go in the non-current section. So I've just included a space there to divide it out so that you can see that. On down to liabilities. Hopefully you can read through those yourself, and if you have any questions, bring those up. But unearned revenues, for example, let's take that one. That is something where we receive cash for something that we haven't done yet. So we receive the cash in, we haven't done anything yet, so we have a liability to perform the service. Later on, once we perform that service, we'll move it from the liability to the revenue. We'll get into examples of those once we start doing transactions. Accrued liabilities, these are amounts owed but not yet paid. So for example, you have a utility bill that comes in December, but you don't pay it until January. You've already incurred it in December. Remember that we record expenses when incurred, so we'll record that in December, but we haven't paid it, so we set it up as a payable under liabilities. Now in the equity section, you'll see the accounts listed for a corporation's equity. Common stock is investments into the company. Dividends are withdrawals from the company. So as people pay into the corporation, they have common stock coming in, and dividends are what happens when it goes out. Now, if we were looking at an individual sole proprietorship or a partnership, what we would see instead would be a capital account instead of common stock. So you might see James Webb, comma, capital, and that would be my investments into the or into the partnership. And instead of dividends, you would see withdrawals. So as I take money out of the corporation, they track that in the withdrawals account. That's essentially the same as dividends, but for sole proprietorship or partnership. So keep those in mind. Revenue and expenses are going to be the same regardless of whether it's one of the three types of business entities. Now let's look at the analyzing and processing transactions section. What is the ledger? Well, the ledger is just a list of all your accounts. So we have all our different accounts that we've gone through down the page: cash, accounts receivable, equipment, accounts payable, common stock, etc. All those individual accounts would just be grouped together, and that would be in what we would call the ledger. Now, if we have all the accounts listed out, there's an example on page 52 that is called the chart of accounts. So essentially, they're the same thing. Chart of accounts is just a list. The ledger is just the grouping of all the different accounts. Moving on to the second page. When we think of an account, we'll just take cash, for example. The best way to view the account and get the dry erase board out here is in the form of a T account, and it's real simple. You just draw a T like this, and you put the account name on the top. So we'll put cash. So this is our cash account, and what we'll do is we'll make entries into this T account for the different pluses and minuses as we go through our journaling process. We'll draw a line down here, and this will be the final balance here. So when we look at our T account, there's a left side and a right side. And the only thing I want you to remember about the left and right is this is debit, and this is credit. So the debit's on the left, the credit's on the right. In my on-campus classes, I always make them say a little rhyme, and it goes Debits on the left, credits on the right, accounting, accounting, fight, fight, fight. And typical traditional undergrads kind of think that's funny. We'll save that for the adult version of the class. But if that helps you remember it, remember that chant. But all that means is debits are on the left, credits are on the right. It does not mean anything related to increasing or decreasing. That is going to depend on what type of account that we have. So let's continue down the sheet here. Now let's look at our basic accounting equation again. Assets equals liability plus owner's equity. When we have T accounts here, underneath each one, whether they're increased or decreased by debits or credits are going to depend on whether it's an asset, liability, or owner's equity account. So if it's an asset account, it's going to be increased by debit. Think of it left side of the equation. If it's a liability or owner's equity account, it's going to be increased by a credit. Okay, so what you need to do first is think of what type of an account is this? This is a liability, asset, owner's equity account, and then you'll be able to see whether debits or credit are going to increase it. Now, a little caveat here is when we're underneath owner's equity, remember we talked about the different types of accounts that are here. We had common stock, dividends, revenue, and expenses. Okay, now some of these increase owner's equity and some of them decrease. Now remember, common stock is coming in, so that's an increase to equity. Dividends is cash going out. Revenues increase owner's equity, expenses decrease it. So now if it is an account that increases owner's equity, that has a normal credit balance. If it's an account that decreases owner's equity, it works against this right here, so really it has a debit balance. So here we have common stock, that's going to have normal credit balance. Dividends are going to decrease it, that's going to have a debit balance. Revenue is going to have normal credit balance, and expenses are going to have normal debit balance. So whenever we look at making a journal entry to increase an account, we need to basically say what type of account is it? Is it going to have a debit or credit to increase it? Now the best way to understand these accounts is to look at pages 57 through 62. There's a lot of different entries there that are going to be showing you the debits and credits, accounts increasing and decreasing. And so use that same process of saying what type of account is it? Asset, liability, owner's equity, using that mindset of if it's an asset account, it's going to be debited to increase it. If it's liability or owner's equity, we're going to credit it, and work through those 6 pages and look at the different types of transactions. Make sure you understand those well, because that's a foundational concept that we're going to carry forward into future workshops. 3 different rules to keep in mind. There's always at least 2 accounts affected, so we don't ever make an entry for cash and cash, a debit and credit there. That would be pointless because it's the same account and doesn't really do anything. Second one, there's always at least 1 debit and credit. Now I say at least 1 because there can be plenty. There can be many of each different type. It can be a complex transaction, but there's always going to be 1 debit and credit. And the final rule is debits are always going to have to equal credits. That's a basic rule of double entry accounting. The last thing I wanted to do was give you a devotional for the week, and I picked a book and a movie based on the same man's life. The book is Amazing Grace, William Wilberforce and their heroic campaign to end slavery. The movie is just simply called Amazing Grace. Came out about 3 or 4 years ago. Also about William Wilberforce. William Wilberforce was a parliamentarian in Great Britain who stood against the slave trade. A parliamentarian is essentially a congressman, as we might view it, but he was essentially the only one battling for several decades to abolish the slave trade. Finally, almost on his deathbed, he got this ratified through their Congress, through the House of Commons and the House of Lords, and stopped the evil practice. But when everybody else was looking at it for economic reasons, he examined the ethical and moral and Christian side of slavery and the slave trade. And about 20 to 30 years before the Civil War was when it was abolished in Great Britain. So a lot of the momentum that occurred in the abolitionist movement in America was based on his work over in Great Britain, and just a really impressive movie particularly. So this would be a really easy Friday night movie to share with your family if you want, a good wholesome movie. And I encourage you to check that out and let me know what you think. All right, we'll see you for workshop 3. Thanks.